All right. Hello, everybody. We're going to have a lot of fun today with an election special here on today's Wealth Wednesday. This is Tony here. Just let me know if you guys can hear me. We had some technical issues at the beginning of this, and I had to like restart the stream several times to get it to work out. And actually, you know what? Now that I'm seeing it show up on Facebook over here, I think I got to switch the picture-in-picture piece. So just bear with me for just a second here. We're going to go over here. I'm going to go like this. That should be better. And then back to here. All right, cool. So I'm going to just make sure there's a little bit of a lag in terms of what comes through on Facebook. So I just want to make sure that this is coming through and everyone can see the actual presentation clearly. But yeah, there's obviously a lot going on with the election. The market's having a lot of volatility, even more than usual over the past couple of days. People are getting those jitters. And what I really want to do today is set aside a lot of the fear and a lot of the bias and stuff like that, and just really focus on numbers and hard facts. So as we get through this here, we're gonna try and be as objective as possible. I really don't want to talk about candidates per se. I really want to talk about policies. I don't want to get into like feelings or what, speculatively what might happen. I want to focus on the facts as we know them and as these candidates and just the process overall, how it all really works and what the likely impact is really going to be for a retiree. So let's actually get into right off the bat here. The most easily, I should say the hardest point that to refute, the most obvious thing that we could all say is that there is one thing for sure that the market wants. If we look back through history and we look at all the different combinations of Republicans, Democrats, red, blue, House, Senate, president, all those different types of things, the one thing that the market wants is a divided government. So whether that means the presidency being Republican and the House and Senate being Democrat, or vice versa, or Biden winning the election, but the Senate staying for the Republicans, this concept of a divided government is the main thing that I can say for a fact that the market wants. And here's the data that I would use to prove that point. If you look at all of the market returns going all the way back to 1928, the return we've had 46 times that we've had a unified government, meaning Republicans, Democrats, President, House, Senate are all the same party. That's been 46 times. And the median return, so the medium, growth rate in the stock market has been 8%. Versus when we look at a divided government, we have an 11% median return. So it's obviously a big gap there. There's a 3% gap, meaning over the long haul, the market has done 3% better under a divided government than it has under a unified government. So then I'm just making sure. I hope everyone can hear me. I'm not seeing any comments. I just want to take a quick second here. And of course, now my iPad doesn't want to cooperate with me either. So got it. Okay, so people are getting the sound, so that's good. I just want to make sure I wasn't going to ramble for the next 20 minutes and nobody could hear me. So it's good. I'm glad you guys can hear. So we're going to move on here. That divided government is a big deal because I think it's probably the most probable outcome of all this. What I really want to focus on next is the policies themselves. And we kind of know what the world would look like under Trump because we just lived under it for 4 years, and there may be adjustments and changes going forward. But the biggest unknown here is what would the world look like if Biden wins? And I don't want to speculate on stuff. So I'm really trying hard to stay as factual as we can on all this stuff. And what I want to do is let's just look at his tax plan. So again, there's a process to this. Just because he wins doesn't mean that all of this stuff is going to be implemented. We all know that. We'll talk about the process a little bit more later on. But what I want to do is let's just pretend for a minute that it was all implemented. Because I think a lot of the fire and brimstone and fear you're seeing right now is quite frankly really unfounded. So we're going to go through these piece by piece. Before we do this, I want to make clear, I don't like taxes, okay? I am a low tax, small government guy. So as we go through this, it might sound like I'm defending taxes, and I'm not. The point I'm trying to make is that the impacts of all of these things are going to be much smaller for the people on this call than what you guys might think. And that, in my opinion, most of these are just really not things you need to focus on. So first, we're going to start off on Social Security taxes. Under the Biden tax plan, what he has said is for incomes above $400,000, they are going to have the Social Security taxes. So if we just back up a minute and we say, where are our taxes today? On the left here, there is a 6.2% tax for employees and a 6.2% tax for employers on the first $137,700 of income. After that, right now, there's no Social Security tax. He is not saying, at least the way that I read it, the way the Tax Foundation reads it, he is not saying we're just going to have everybody pay taxes. He's saying the people above $400,000 are going to have to pay that extra 12.4% into Social Security. Well, here's the thing. We mainly work with retirees. About 90 to 95% of our clients are either retired or they're going to be retired within the next 18 months. So for us, even very wealthy people, $2, $3, $4, $5 million in assets, most of them are not showing $400,000 or more of income. Most of them are going to be falling in this lower area if they have earned income, or the middle area, or if they're in retirement. They're not even going to have the FICA taxes, because that's on earned income. So what I'm going to say, again, this is probably going to be a little bit controversial, but the Social Security tax is actually good for the average person on this call because they're not, again, 99% of the people watching this, you're not going to have to pay in that tax, and it actually is going to make Social Security a lot more solvent. So I think if that piece were to go through, that would be on net very good for everybody on this call. The second thing is Joe Biden is talking about resetting the estate tax exemption. So right now, if you have an estate up to $12.5 million in assets, you don't have any estate taxes. Joe Biden wants to take it back to a $7 million exemption, meaning if you have a married couple with $6 million and they were to pass away, there would be no estate taxes. Here's the thing. For some of the people on this call, that's going to be bad. Meaning there's going to be a lot of people on this call that are going to have estates larger than $7 million. But here's the thing. We can plan around estate taxes. Okay, so this is, I don't want to say totally avoidable, but a lot of the negative impact of this, we can do something about. So if there is an estate tax exemption that gets reduced back down to even something crazy like $1 million, there's a lot of games we can play. And I would say that an income-focused and estate-focused retirement advisor is going to become much more valuable. So I'm frankly not that concerned about the estate tax exemption. We won't be able to quite go all the way to Donald Trump's level of tax planning, which I'm pretty impressed with, but we can do a lot of things to really get that bill down for your estate taxes. Okay, and then line 3 here, Joe is talking about raising the top income tax bracket, which currently sits at 37%, raising that back up to 39.6%. I'm not going to focus on what might happen economically and different stuff like that. It's a 2.6% tax increase. And again, none of our retired clients are showing incomes above $400,000. So it's not going to affect anybody on this call right now. This next one, though, is pretty important. So I actually want to take a second. Joe Biden is currently talking about eliminating the step up in basis. And I want to go through what that means, because a lot of people aren't really familiar with it. So right now, imagine that you own a stock. Let's say you paid $100,000 for that stock. That was your cost basis. And then, something terrible happens, you pass away, and the value of that stock is sitting at $300,000 on the date that you pass away. The way the law is currently structured is what happens is something called a step up in basis. And all that it means is these $200,000 of gains that you're seeing in the dark blue there, it goes away. And they just allow whoever inherits that stock or that ETF to get a higher cost basis of $300,000. There's no capital gains tax. That's super valuable. Okay, we just said, hey, we just eliminated $200,000 of capital gains, right? What Joe Biden is talking about doing is having no step up in basis, meaning if you have a position you paid $100,000 for, a couple of years later you pass away, it's at $300,000. You would be in a position here under the Biden plan where you would now have $200,000 in capital gains that are taxable. And then, under capital gains taxes, you would pay 15% capital gains rates, $30,000. And a lot of people are going to say, time out, Joe Biden's talking about raising capital gains. I agree. He is talking about raising capital gains. The way the plan is written right now is that he wants to raise capital gains taxes only on the incomes above $1 million. So in this position, if maybe you had $100,000 of income between Social Security and IRAs and different stuff like that, and then you had an additional $200,000 of capital gains, this person would still, even under Biden, would still be in that 15% capital gains tax bracket, and they would pay $30,000 in gains. So I don't want to minimize this. That is a $30,000 tax you would not have had, prior to, say, Biden winning and his tax plan getting enacted. What I will say is that is the single most unlikely piece of his plan. And I'll show you what I mean by that in a minute. We're gonna go through the process of how these laws get enacted and also the incentives for some of these different people that are involved. I do think that's bad. So to be clear, the worst thing for the average person on this call, the worst thing would be the elimination of the step up in basis. That would by far be the biggest negative impact financially. But what I'm also saying is that's probably the least likely. And there's another piece here that will affect some people on this call, especially if you're not on Medicare quite yet. He's also talking about premium tax credits, having those subsidies be based on the gold plan instead of the silver plan, which that would in effect be good. Okay, that would mean larger subsidies for people under the age of 65. So in general, what you can see, again, I don't want to defend taxes. I don't want to say, yes, we should all, pay as much taxes as possible. I'm just saying if you're a retiree and your income is under $400,000, even if his entire plan got passed, the Social Security part of it would be good for you. The real estate exemption, we could pull some Houdini stuff and help you get out of. The top income tax bracket goes up 2.6%, but you're not in retirement. You're not going to be falling in the top income tax bracket. The elimination of the step up in basis would be negative, but it's very unlikely, as we'll get into in a minute. And then the premium tax credits would be good. So we basically have good, neutral, unlikely, and good. Okay, so I want to get that point across. We don't need to be fire and brimstone and think that, our tax bill is going to double or triple, because I really just don't buy that. I think it's a lot of hyperbole. Now, what I want to spend just a minute on here, if you remember this guy from the Schoolhouse Rock, I think this was I looked it up. I think it's from like 1973, but the whole process of how a bill becomes a law. I'm not going to turn this into a civics class or something like that, but just right now, he's talking about something that's not even proposed as a bill yet. He's talking about his plan being an idea. Once he gets elected, if Joe Biden were to get elected, which first, that's an unknown, right? I think right now the election's 50-50, personally. I really believe it could go either way. And I don't want to talk about polling. I don't want to talk about picking states or different things like that. I really want to talk about the probability of a negative financial impact to the people on this call. Right now, he's talking about an idea. If he gets elected, there's a chance that becomes a bill, okay, an actual bill. Then it would have to pass the House. Then it would have to pass the Senate. Then he would have to sign it into law. And then depending on some of these things, it would have to hold up to legal challenges. And we know that right now the Supreme Court, sitting at a pretty strong conservative majority, I think some of the legal challenges on the back end of a lot of tax hikes would get pretty interesting, especially around Obamacare. So that's the process. And just remember, if Joe Biden were to win the election, historically, under current legal precedent, the earliest he could actually raise taxes would be for the 2022 calendar year. And if you remember, when Donald Trump got elected, it wasn't until the 2018 tax year, even though he won the 2016 election, we didn't get the reform until 2018. And that's because the legal precedent is really strong. And I would say that legal precedent only got stronger under the current Supreme Court. So you're talking about a tax hike potentially 2 years out at the earliest, if he gets the Senate and gets everything else they want and he wins the election. There's a lot of unknowns in there. He has to win the election. Democrats need to win the Senate. And then he needs to get this all passed before 2022 and survive a Supreme Court challenge. So again, I think some of these things are more likely than others. But what I really want to focus on down here, again, we talked about the value of having a divided government and how over time a divided government is much better for the market because there's gridlock and there's not a lot of surprises. There's not a lot of new laws. There's not a lot of tax code changes. The status quo is actually pretty good for business. Okay, so this is if you said, Tony, what do you want? What I want is a divided government. I don't care which piece of these are red or blue. What I want for my clients, the thing that I think leaves my clients in the best position, is basically for nothing to happen. No legal changes, no tax code changes. I think we're in a very, very good situation from now to say 2026 if literally nothing happens. So that's where I want to be. But let's move on here and talk about, as I've been talking about some of these tax changes being more or less likely. I don't know how clearly this is going to come through, but if you go out and you type in, Biden campaign top donors, I think you're going to be really, really surprised by this list. So he's talking a lot about capital gains increases and top bracket increases and different things like this. But you'll notice, so we have some Democratic PACs, political action committees up top here. Look at the rest of these donors. Hedge fund, 9 million. Hedge fund, 7 million. Private equity company, 5 million. Real estate investment trust, 4 million. Renaissance Technologies, one of the biggest hedge funds in the world, 4 million. We're going to keep going down. Marcus Millichap, giant real estate investor, 4 million. Alphabet, so Google, tech company, 3.7 million. Hedge fund. Microsoft, tech company. Bain Capital, private equity. Sequoia Capital, private equity. Why am I bringing this up? Well, right now it's really cool to talk about tax hikes, right? Because he's trying to get that base on the left that wants the rich to pay their fair share. He's trying. When I say he, Joe Biden is trying to get elected by rallying his base around this idea of the rich people paying more taxes. What I'm here to tell you is that when, say, 15 of his top 20 donors are hedge funds and private equity groups, one of the very first things that's going to go missing when his tax plan becomes a bill is all the capital gains stuff. Okay. It's just, call me cynical, call me whatever. I'm just saying that the incentives right now are structured in a way where it is very, very, very difficult, whether it's Joe Biden, Kamala Harris, or whoever it is from the Democratic Party, to pass major tax hikes. Now, I do think they would get the Social Security piece of it. I do think they would even potentially get the increase in the top tax bracket. I do think they might get some of those other things. I think it is highly unlikely that anything related to capital gains changes all that much. And again, it's just from following the money. So if you look at where the money for the Biden campaign is coming from, it's coming from people whose basically entire businesses run on capital gains and depreciation advantages for real estate companies. So I think those things are not going anywhere. I think it is highly unlikely. I mean, you don't get me wrong, you might see some sort of change to the step up in basis rule that we discussed earlier. I do not think you're going to see a situation where we all of a sudden have no step up in basis just out of the blue, because again, 50, 60, 70% of his donors would be really burned by that. And of course, they're going to say, hey, Kamala, if you want more money from us for your reelection cycle, you better not raise capital gains taxes. And then you got to remember, too, this list looks fairly interesting, right, of all the hedge fund donors to Biden. The list at the senator level and at the House of Representatives level is actually much more tilted, even in favor of the hedge funds and real estate investors and different things like that. So it's actually much harder for those bills to get to the president with those capital gains increases, and then much less it would have to survive this gauntlet of private equity and hedge funds. So in a nutshell, I think a lot of the most severe changes are the most unlikely changes. And I think in the past, what we saw, even with Donald Trump's tax cut, say what you want about the guy, Donald Trump. I'm not here to campaign for him or against him or whatever. But if we just look at the facts, the tax cut he was able to get through Congress was not nearly as aggressive as the tax cut he wanted. I think as strong as the status quo and the establishment was entrenched back then when he was trying to get his tax cuts through. I think it's actually going to be much harder to get the tax increases through. So you may get some of them, but even then, you're probably talking it would have to be a Democratic sweep. So Democrats would have to win the presidency, they'd have to win the Senate, and then they would also have to basically act against their donors. They would have to go out and say, hey, Mr. Hedge Fund, even though you were my fourth largest donor, I don't want any of your money in the reelection cycle. I'm not really that worried about reelection. It's more important to me that we do the right thing and that rich people pay their fair share. And again, me being a cynical guy, I don't really see any of that as too likely. So we'll move down here. What I want to talk about is, we've seen a lot of volatility in the market here over the last couple of days, and I want to keep the big picture in mind. So as you're sitting here, a couple days before the election, the biggest thing that we're going to know after the election, besides win or lose or whatever, which, by the way, I think we're going to know the answer to that question much sooner than a lot of people think. I was actually going to make a slide on this, but let me just talk about this real briefly. We're in a position right now where like 60 or 70 million people have already cast their vote. I think we're going to be in a position on election night where maybe something like 70 or 80% of the votes have already been counted. So what I think you could see is when the East Coast polls close, they call the election for all of those East Coast states. They're just going to go, Maine goes here, this goes here, North Carolina goes here, South Carolina. And I think it's going to be a very unique election night. Usually the polls close, they wait 2 or 3 hours and they start projecting. I think they're going to have very interesting firm numbers where they're going to say, hey, 80% of the votes are in this state, is 5% tilted this way. Boom, we're going to call it. I'm not going to speculate on a contested election, meaning I'm not going to speculate if Donald Trump is going to say there's voter fraud or any of that type of thing. But what I will say is right now, over the last couple of weeks, the betting markets have been creeping to a much, much sooner resolution, meaning they think within the next day or two after the election, we're going to know the answer, rather than originally people were talking about it getting dragged on into next year. So I think this is going to happen very quickly. I have no idea how it's going to go. I think it's going to happen fast. I think you're going to see states getting called way earlier than we've ever seen them get called. I think polls are going to close and they're going to be calling states. But I want to just talk about what we're seeing out there in the market right now. So this is the cash balance in cash accounts and also held in like short-term U.S. treasuries. And you can see if we were just looking prior to the financial crisis, we have this blip here in 1995, but going across the whole rest of history coming up to the financial crisis, the cash and treasury bond position of individual investors has never been above about $200 billion of, again, cash and treasuries. And then what you saw in the financial crisis, they ripped up to $800 billion of cash and short-term treasuries. Everybody lost their minds. They said, oh, the U.S. economy is going to zero. We're going into a Great Depression, et cetera, et cetera, et cetera. Now what we've seen is a level of cash and treasury holdings that is literally unprecedented. So we're talking 2, 3, potentially when the next report comes out, I think we could see as much as 4 or 5 times the level of cash and treasuries that we saw in the financial crisis. So basically, in a nutshell, people are freaking out. Okay. And I get it. There's a lot of uncertainty right now. There's a lot of confusion. There's a lot of, is this going to be contested? Whatever. I want to tell you a little bit of a story. So if we'll get to the story in a minute. This is a really interesting statistic. So this is from Yale. You can go Google this if you want. It's called the Yale Crash Confidence Survey. As I was talking about fear a minute ago, what this measures is every month they ask everybody. I believe it's like 1,000 individual investors, 1,000 institutional investors, but they have all the data on the Yale site. They say, what do you think are the odds of a stock market crash in the next 12 months? And you can see back here, during like before the financial crisis, people were feeling pretty good. So let me tell you what these numbers mean. This number up here, which it might be kind of hard to read, but this translates into 60. This means 60% of people were saying, I don't think it's very likely that we get a stock market crash in the next year. And of course, that was in 2007 and early 2008. And then we got this big crash. And then down in the depths of that, of when the market was panicking and when everyone was the most afraid, that was when actually you were getting numbers like only 20% of people saying there's not going to be a crash in the next year. So what I'm getting at here is people have a record historically of being very, very, very bad market timers. They tend to be the most confident at the top. They tend to be the most scared at the bottom. This might surprise you. They've been doing this study back into the early 90s. I'm just showing you the last like 15 years or so. Right now, we are in a situation where there are more people that think the market is going to crash over the next 12 months right now than they were thinking during the financial crisis. Okay, so I just showed you the slide above of the unbelievable amount of cash sitting on the sidelines. And then we moved on. I talked about a more statistical measure of fear. So whether you ask people what they think or whether you look at what they're doing, the bottom line is people are really, really scared right now. In the last couple of days in the market, we've seen a lot of pressure on stocks. We've seen volatility all over the place. And I want to share this story with you. So if you know anything about us, if you've been following us at all, you know that after college, I got hired by this guy on the screen, Stan Phelps. And Stan, very well-known guy, billionaire, junk bond, high yield bond guy. But what really stuck with me from Stan, and he passed away last summer, but what really stuck with me that he always drove into my head is that the crowd is wrong. And he said this so many times in so many ways that it's really hard for me to get this across in a real brief situation. We only got a minute or two left. But so here's Stan over here on the left. This T-Rex. He donated a couple dinosaur skeletons to the Yale Peabody Museum. So there's a whole like wing that's the Phelps wing, but really interesting guy. Gave a lot of money away. He passed away last summer. Left a lot of money to a lot of different causes. But if I came to him right now, I recently played this through in my head, and I said, if I came to Stan right now with that crash confidence data, and I said, Stan, did you see the Yale crash confidence? 88% of people think the market's going to crash around the election. They think whatever, Biden's going to win, everything's going to crash. I can guarantee this is what he would say. Okay, so this is going to be a little hard to believe, but this is a guy, very well-known, very respected guy. His, well-known guy. He would say this. He'd go, 88% of people think the market's going to crash. That's fantastic. Are we fully invested? And I just know if you know Stan, this is what he'd say. And then one of the newer people would go, "What, Stan? What are you talking about?" So this is really direct, but this is how Stan was. He would sit you down and he would go, Bob or Sue or Bill, whatever your name is. He'd go, "Are most people rich?" And it wouldn't take very long, and someone would go, "No." And then he'd ask you, why aren't they wrong, or why aren't they rich? And there'd be a lot of back and forth. He'd say they're rich because they're wrong. Okay, and they're getting out at the bottom, they're getting in at the top. Their timing is poor, And regardless, okay, I know there's a lot more things that feed into rich or poor. I'm saying this is what Stan would say. Okay, he would be very confident that they got to be wrong this time too. And I've heard him say that on way more than one occasion. And I just know that if we went back and we look at this and we look at all of the times that people were the most afraid, those were the best times to get in. And if we look at all the times that there was the most cash parked on the sidelines, those are the best times to get in. So again, I'm not saying, I want to be real clear on this. I'm not saying rush out and go buy a whole bunch of stocks. Don't try to time it. But what I will say is I think looking back, we're gonna realize that stocks are a much better value right now than what a lot of people think. And that the changes in the government, the changes from a Joe Biden presidency, the changes, whatever, are probably going to be much smaller than what a lot of people think. And in my opinion, again, I know the market could have a real rough day the day after the election. I completely understand that. I'm just saying that historically, it's pretty unlikely. And we have to go off history. We have to go off statistics. We have to go off probability. And then we just have to go off that herd mentality of, if you go poll 1,000 people, there's not too many people in there that are famous billionaire investors. Okay, most of them they might have 5 or 10 grand in a 401k right now, or whatever it may be. And if they're scared, I want to be aggressive. And Warren Buffett has that line, be greedy when others are fearful, be fearful when others are greedy. Well, right now, if you look across the entire United States, the vast majority of people are very fearful. And I would say that it's a time to be positioning yourself for the long haul for the next 20, 30 years. I think it's pretty likely that these are decent entry points, especially if you're going to be holding them for the next 20 or 30 years. So to close this out, I just want to remind you guys, follow the money. Don't worry about what the president or the presidential candidate is saying. Look at where their money's coming from. And that really tells you everything you need to know about what's going to happen to the tax code and what's likely to happen for you. So I want to thank you so much for watching and for joining us on this call. Sorry about a little bit of my tech issues on the front end of this, but it was a lot of fun. I didn't see a lot of questions coming in, but if you guys did have any questions, feel free to type them in there, or even go ahead and shoot me an email or give me a phone call here at 920-544-0576. Would love to chat about anything, because over the next few days, I know a lot of people are in kind of a holding pattern. The market's making a lot of people jittery, but I just want to make clear to you guys that our approach to this stuff is very long term. We're looking at the next 30, 40, 50 years. And I think it's much more likely that this is a pretty good entry point, and that anything you're doing right now, you want to be positioning yourself both ways. You want to hedge. You want to make sure that you're not in a bad position if, say, Biden were to win or whatever. But if you're diversified and you have a tax first mentality, tax planning and fee, minimizing your fees, keeping those tax drags low, you're going to be in a situation where you can sit back and go, hey, it matters a lot more who's controlling my house than who's controlling the White House. That's the position we really want to put you guys in, where you're at the wheel, you're in control, and you're able to go accomplish your goals and live the retirement you've been dreaming about, rather than being scared and worried and focused on an election or focused on what some politician is promising. Because I think we all know how much a promise from a politician's worth. So we say that, but then also don't let their promises scare you. Okay, so this is Tony from Safeguard Wealth Management. I just want to remind you all, you don't need more money. You need a better plan, and you need a very, very long-term plan. Thanks so much for watching.